This video is intended to provide a brief discussion on the net operating loss limitations under Section 382. This topic is particularly relevant subsequent to reorgs because, of course, one of the things that we discussed over and over with reorgs, but we didn't really dig in very much, was this idea that tax attributes carry over. And one of the tax attributes that we constantly mentioned was net operating losses. So if you end up with an acquisitional reorg and the target is a loss corporation, then that means that NOL carries over to the new company. And of course, it's no surprise that the IRS and Congress has made a few rules around that. So let's start with a brief discussion of 382 in general. So Big Income Corp is a large profitable corporation. And they pay taxes every year like a company would. And they're generating, pretty much every year they're generating positive taxable income. Loss Corporation, on the other hand, they've been suffering financially. Really, in fact, they're right on the edge of bankruptcy. And so they've got nothing but NOLs and big fat NOLs, right? So what we have is this target that is probably of low value, but has a giant NOL. So because it's nearly worthless, Big Income Corp can tender an offer of shares, right, and say, hey, let's do a reorg, and we'll just acquire you, Loss Corp. And Loss Corp shareholders probably not too concerned about that because they're like, hey, even if you're offering me nothing for my Loss Corp, it was worth nothing. So in theory, you're paying me fair market value. And now I end up with some ownership of Big Income, and it's a tax-free reorg. So it's not like I had to sell Loss Corp or any of that, right? So I end up maybe in a good situation. But the one who really ends up in the great situation is Big Income Corp. Because without 382, they now have access to Loss Corp's NOL. Because remember, these tax attributes carry over. And that means under the current NOL rules, they could offset up to 80% of their future income by spending this small amount of investment, right? So with a small investment, they have the opportunity to generate giant tax savings because that small investment was really buying an NOL, right? That's really what they were after because that was, to them, the value. And as you probably noticed, as we've worked our way through this entire semester, one of the things that Congress really doesn't care for is when a taxpayer gets to take tax losses when there's no equal economic loss. And that's clearly the case here, right? Because Big Income is just generating giant NOLs now to offset their own income with no real economic investment. So, without 382, this is the perfect deal, which of course is why it's not permitted. Section 382 was largely created to serve as a barrier to just such transactions. So let's think about stepping into the shoes of Congress and saying, okay, we have this situation that we want to stop. And, what we don't want to do is let, Big Income Corp suddenly for small money acquire this huge value of net operating losses. So one thing they could do is look, if you acquire NOLs, they don't carry over. That is a tax attribute that's not going to carry over. But the issue is there are legitimate business transactions that just happen to involve a loss corporation. And in fact, there are a lot of them. So all the biotech startups in San Diego, they generally operate at losses, but they're often acquired at the end, right? Some go public, it's true, but many of them are simply just acquired by Big Pharma at some point. And so, they're not acquiring the NOLs, they're acquiring the intellectual property of that underlying small company that just happens to have generated a lot of NOLs as it got its start. So we needed a better rule. And so, the thought would be, well, look, why don't we try to create a system where we'd say, look, we'll let you earn out whatever NOL you could have used if you hadn't been acquired, right? So if you had remained a standalone company, what do we think you would have been able to generate in terms of income in order to then offset your NOL in future periods? So that seems fair, right? I think from a philosophical perspective, that's a good policy perspective. But how on earth could we measure the income that loss corporation could have earned in future years? We actually have no idea. what they could have earned in future years. So the idea is, why don't we establish some sort of return, right? Some sort of return on investment that we're going to associate with the fair market value of that lost corporation, right? And so the idea is, well, we'll take the market value of that lost corporation and say, well, what we would have expected is you would earn some return on the market value of your investment. So rather than just let anyone decide what that return would be, the Congress said, you know what, we're just going to publish rates, right? So we'll just publish a rate, and that's the return rate that you're going to use. And we'll talk about how that rate is derived in a little bit. And that is effectively what 382 says. Okay, so who does 382 apply to, right? Because this is an NOL limitation. And of course, all taxpayers would prefer to have no NOL limitation at all. They prefer to just take all the NOL if they can. So the prerequisite ownership change that's required to trigger a 382 occurs when there's been an owner shift involving a 5% shareholder or an equity structure shift. And I will tell you, we're just gonna go over the very top of these ownership change rules because they are super complex, and the code is complex, the regs are complex. And of course, if you're dealing with the acquisition of a loss corporation, that's when you're going to need to dig in on the 382 rules. So to some extent, we'll give you some exposure in this class, but if you're ever facing M&A of a loss corp, then you know you're going to have to really dig in. Okay, so that owner shift or that equity structure shift causes the percentage of stock of the loss corporation owned by one or more 5% shareholders to increase by more than 50 percentage points over the lowest percentage of stock that the loss corporation owned by such shareholders at any time during a test period ending with the shift. So there's two things going on. So first off, this should feel a little bit similar to kind of our redemption rules, right? So, okay, what we're looking for is some fairly dramatic shift in ownership. And a little bit different than the redemption rules is there's going to be some test period that we look at. So rather than try to make some common law estimates about when that redemption occurred, we're just going to look back over a period of years. So a loss corporation, right, this only applies to a loss corporation, is any corporation that has an NOL carryover from a prior year. It's a corporation that was operating at a loss and therefore on its way to generating an NOL in the year of the ownership change. And for years beginning after 2017, it's any corporation with a carry forward of the disallowed business interest deduction. So the 163J interest deduction limitation. We didn't spend a lot of time on that, but we did talk about it briefly. Okay, so example number one, there's an individual that previously didn't own any stock of the loss corporation. They acquired 52% of the stock via a tender offer. Following the tender offer, the individual is now a 5% shareholder, right, because they own 52%. And that ownership percentage has increased by more than 50 percentage points, right? So it's gone from 0 to 52. So that's going to trigger an ownership change, and 382 is going to apply. In example 2, we've got this loss corporation, and there are 10 unrelated individuals that previously did not own any company stock, and each of them individually acquires 6% of the loss corporation stock. So now following the acquisition, each of the 10 is a 5% shareholder because they each own 6%, and each separately caused a 6 percentage point increase. So in the aggregate, they have caused a 60% point increase. That triggers an ownership change. And one of the things that is worth mentioning is when you are a loss corporation and you have greater than 5% shareholders, pretty much any time they're playing in your stock, doing buys or sells in any way, you really need to be cautious about whether or not you've triggered a 382 limitation, because you may not have planned on a reorg. It may simply have been some exchanging of shares, but you've created this shift in ownership, and suddenly your net operating loss is limited under 382 just inside that same old loss corporation. So this is a trap for the unwary, right, which we've talked about that idea before. 382 has an intended purpose, but sometimes, innocent players get caught up in it. So to be clear, the terminology used doesn't always match its plain English meaning. So an ownership shift doesn't necessarily result in an ownership change. That's kind of what I spoke about before. And a shift that is significant enough to trigger is based on percentage points rather than percentage. So the testing period, remember we talked about you're gonna have to look back and then you accumulate all the ownership shifts over that period. That's 3 years, ending on the date of any owner shift involving a 5% shareholder. Okay, so to be clear, if any of your 5% shareholders have a shift, then you now look back 3 years and look at all the equity shifts that occurred over that time. Again, if you are a loss corporation, you got to be really careful about accidentally 382ing yourself. And that's what that note says. Okay, so how do you calculate this limitation? Let's kind of go through the mechanics because we talked about it conceptually. It's like, okay, take the fair market value, multiply by an interest rate. Yeah, that's exactly what you're going to do. So if you experience this ownership change, your ability to use these NOLs, and it's not, by the way, 382, we're focused on NOLs. It also covers net capital losses. It covers net recognized built-in losses, depreciation deductions attributable to those losses, and other tax benefits. So 382 is all-encompassing. And if you look, 381 and 382 really walk in tandem. They're kind of the tax attribute sections. So at some point, I would encourage you to dig in on 381 and 382. Like, we're going deep enough for the CPA exam. But again, if you're dealing with clients that are loss corporations, which is common in San Diego, you really want to have a pretty good understanding of this. 382 limitation, generally the value of the loss corporation multiplied by the long-term tax-exempt rate for the month in which the ownership change occurs. So you think, okay, well, that's pretty simple, right? Take the fair market value of the loss corporation multiplied by the long-term exempt rate for the month in which that ownership change occurs. However, the long-term exempt rate isn't really just the long-term exempt rate. As usual, they complicate things and they say, okay, it's actually the highest of the adjusted federal long-term rate that's been issued for any of the 3 months ending with the month in which the change occurs. So if, for example, in this situation, the change occurred in October of 21, you'd look back 3 years and you take the highest rate, which happens to be August 21 of 1.58%. And you can see one of the issues we've been dealing with is long-term rates are at remarkably low levels. And in a big part, the Treasury and the Fed have been controlling interest rates. And one might argue they've been doing that artificially, right? I mean, we're not going to get into the whole, federal open markets thing, but the fact of the matter is, in order to stimulate the economy, the Treasury's been buying back assets and they've been depressing interest rates. That's just true. Whether plausibly that makes sense or not, you can take an econ course for that. But the reality is these are really low. So if you get stuck in kind of the last decade with a 382 limitation, you're going to end up with really, really low interest rates. Okay, so let's do a quick calculation example. Loss corporation, loss company experiences an ownership change in October of 21. Immediately before the fair market value of the stock is $100 million, and that's generally what you're going to value. And again, when you look at 382, if you dig in a little deeper, the definition of stock is a little more complex than we're looking at, but that's pretty par for the course, right? So the 382 limitation for this year and each following year is that 100 million value times 1.58. Recall that was the August, that was the highest of those three rates. And so the most NOL that they can take in any following year is 1.58 million. And that's just the cap forever. And that cap would exist until the end of time. So again, the value of the loss corporation, we generally think of that as the fair market value of their stock. That includes the value of any plain vanilla preferred stock right before the ownership change occurs. If they're publicly traded, you really are you measure the market cap. There's a safe harbor if the market cap isn't indicative, blah, blah, blah. But again, like I said, we're kind of covering in general what 382 does. So it applies for any post-change year, including the remainder of the year of the change. And that limit to be clear, applies to all subsequent years. Again, not just to the year after. So if Loss Corp has an NOL of $1 million and they calculate the 382 limit, it's 25,000, and their income in the future years is year one 100,000, year two 50,000, year three 70,000, then what would happen is they would only be able to offset 25,000. I'm not sure why I put years 1 and 2. That would be years 1 through 3. Loss Corp can use no more than 25,000 of the NOL in each year. And that 80% limit does apply. So really in year 1, they're only eligible for 80,000. Year 2 will be 40,000. Year 3, 56,000. But the 25,000 is less than those in any year. But 25 is all you can take. So you can kind of realize, okay, how many times does 25,000 go into $1 million? Well, the reality is it's going to take 40 years for this NOL to get earned out, right? And that is, if you will, the damage of 382, right? Like, what value is a $25,000 deduction 40 years from now under any reasonable interest rate? Well, it's almost nothing, right? So to some extent, 382 really is getting at the heart of, look, you're not going to get the benefit of acquiring an NOL company unless that NOL company is actually worth something. In which case, no, all right, well, in that case, the fair market value of the stock is probably pretty high, and the interest rate applied to that market value probably makes sense. And so, okay, yeah, you'll probably get some reasonable NOL. So to be clear, this was even a bigger deal in the old pre-2018 when NOLs had a 2-year carryback, 20-year carry forward, because you could, upon the acquisition of an NOL, you could be facing the expiration of an NOL under 382, right? Simply mathematically, you're never going to be able to take all of it. That would have been the case in this example we just went through, right? It's going to take 40 years. Well, if it expires in 20, it's just done. You're never going to take it. So that would create different issues from a financial accounting perspective, but for a different class. Okay, so strangely enough, if the NOL limit for a post-change year exceeds the taxable income for that year, you actually can use the excess in a following year. So let's do a quick example. So again, we got $1 million, long-term exempt rate, 2.5, limits 25,000. Oh, excuse me. Loss Corp has a $100,000 NOL carryover from prior years. Geez, I'm not sure what that little fact is talking about. Okay, so because it's the Loss Corp, just ignore that last statement, I think. So in year 1, Loss Corp's operating income is 20,000. Of course, the 382 limit is only 25, and we're ignoring the 80% for this example, to be clear, but the 80% would apply. But, to kind of understand the construction of this part of the rule, it doesn't really matter. So what that means is 5,000 couldn't be used simply because it was limited by the amount of income. If next year there's enough income, it can actually carry that 5,000 excess forward to year 2, right? So when your NOL is limited, you can carry it forward to a future year and try to use it in that year. Again, the 80% limit would apply. We're kind of ignoring that, but that does mean you can kind of carry that 382 limitation forward. And again, this was a bigger deal when these expired. Now it's kind of just a time value money game, right? Okay, well, as long as I make money at some point in the future, I'll get to use it. Okay, that brings us to the end of 382. It is at this point in the video I'm going to tell you that this is not on your final exam. I don't think it's fair if we've never had a chance to discuss this face-to-face to really cover this topic. But it is important. And if you end up working in the tax industry or really the accounting industry in San Diego, having at least a vague understanding of 382 will be relevant to your career. All right, thanks. See ya.